But what happens if we get into a regime where the U.S. dollar is firm and steady, which you can get in a post-bubble contraction? And the senior currency becomes chronically firm. That's the term I use, chronically firm. And and the Federal Reserve won't be able to depreciate it. I love it.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. With us now is Bob Hoye. Bob, it's great to have you back on the show.
Yeah, I always enjoy our conversations back and forth, Kerry, and we are living in fascinating times for the financial markets. Don't you agree?
Oh, my goodness gracious. Well, we always knew what was going to happen, but, you see it, you wait for so long, and then finally it actually happens, and it's like, oh, okay, so we were right. It just took a while, right?
Yeah. Well, as you know, I'm a financial historian.
Yes.
And our work in first quarter was that the markets would rise right through to mid-year. Then we got to mid-year and said, hey, it's going to continue right maybe into September, and it could get rather exciting. So this we have, and we're into September, getting towards the tail end of September. But this is going to continue. It is turning into being a really outstanding rise, but on our technical work, it's not yet what we would call ending action. Mm-hmm. So we're going with the flow and let it continue, and we'll just see where it takes us. And it's been wonderful. Now, there are signs out there that are cautionary. There's quite a flow of retail money into the market, which means, small traders, and they don't come into the market at important lows. They come in close to important highs. So we're just going to stay with it, Kerry. It is a wonderful rise, and we will be watching to see if this accomplishes successes.
Yeah.
And we're also aware that if something's going to go wrong, it can be found in October, November. But I don't know. I don't think so. Somehow I think this has got special legs, this stock market.
Yeah, well, it just shows. I play with a little concept called COMEX GPT. It's like Chat GPT. It's the AI that rigs all the metals markets. And lately it's been having a meltdown because all the tricks it's been using for the past 60 years to suppress metal prices, manipulate markets, are failing. And we saw that raid I think it was a week ago, last Monday, give or take a day or two, where silver went down $1. And then within 2 days, it had more than recouped its loss. That's the kind of thing we were seeing back in 2009 and 10,
Yeah, well, what my historical work has done is in a boom, in the good times, silver will outperform gold.
Right.
And it has been. But it also, silver is, the silver bugs, of course, rave about silver all the time because demonstrably you can show that there's a shortage every year. Mm-hmm. But they overlook the fact that silver has a hell of a financial component in it.
Yeah.
And of course, that shows up in the gold-silver ratio. And so this is another one of our little tools. If you get a sudden reversal in silver relative to gold, like it gets weaker, that's a heads up on the overall speculation out there. But silver was in that sort of range pattern for a while, and then you knew that it would just break out and jump up at some point. And we're just going with the flow here, but watching the gold-silver ratio for any change. Now, the other one that we do is also gold's real price. And the traditional way of doing that is deflated by the consumer price index. And that number only comes out monthly. Found a hell of a lot livelier way to look at it, and that's gold divided by the CRB commodity index. And then we've also assumed that the CRB is a reasonable proxy for gold mining costs. And it is. I've talked to, some serious gold miners in the business, and there's another number out there, I can't remember what it is, but they would agree with me that the CRB is a rough proxy for mining costs.
Yeah.
And it has been acting well. But and again, we do our technicals on it, and it's been acting well. So one of the things that I really like about this approach, Kerry, is that most pundits out there, they look at the gold in dollar terms. And, of course, the thesis is U.S. dollar down, gold up, gold stocks up. But what happens if we get into a regime where the U.S. dollar is firm and steady, which you can get in a post-bubble contraction? The senior currency becomes chronically firm. That's the term I use, chronically firm. And the Federal Reserve won't be able to depreciate it. I love it. But that's all right because gold adjusts. And in previous post-bubble disasters, the gold stocks, of course, will go up and down with violent moves in the big stock market. But net out over a few years, that real price going up makes the industry profitable, or is improving profitability, when most industry and commerce are suffering the hard times of a post-bubble depression.
Right.
So this is where we really like gold and have been considering it in the early years. And most of the typically a post-bubble contraction has lasted for about 20 years.
Sure.
With the with the usual 3 to 4 year business cycle coming and going, but in a post-bubble contraction, recessions are disasters and the recoveries are weak. But anyways, the whole thing shifts over such that most industry and commerce is not making much money, and the gold sector is. Now, the market forces behind this, Kerry, are fascinating because you've had a great financial bubble in debt and in junk bond debt. And then, of course, junk bonds disappeared. I mean, they just bankrupt, go bust, default, whatever you want to call it. And then you have a whole row of investment-grade bonds that drop down into junk. So the lower-grade bonds becomes a disaster. And so there's no place to go. But what we like, in a storm, and if we get a serious financial storm, an ideal position, even for equity people, would be 3 to 4 year good grade corporate bonds.
Right.
Because if you're in cash or cash equivalent, the Treasury bill rate, the 3 month Treasury bill rate, which is about 4.38 now, it's going to go down to 0 again.
Yeah.
So you don't want to be in short-term instruments rolling over every month. Forget about it. But this is where we like 3 to 4 year maturities in good grade corporate bonds. So you're going to get some decent income. And then at the 3 year or 4 year maturity, they mature at par. So you get all your money back, so to speak. So that is a very nice place to be for fixed income people. And this, when the storm comes in, it could be a wide disaster to the stock market. So even equity people should be looking at this position.
Yeah.
Makes sense to me.
Yeah, that's for sure. That's for sure. So how high is silver going to go? Are we going to see triple digit silver? Your prediction?
I think we can approach that. Yeah.
Well, Martin Armstrong said 50 and then corrected himself later and said 75. So.
Oh, no, we haven't put a target that high on it yet. Just we're on the trend, and the way we work is when the excesses come in, then we make the notes. So, yeah.
Okay. Well, hey, that's all right.
Yeah.
That's all right. I don't want you to go out on a limb here, Bob.
Well, we've got our list of junior gold mining stocks.
Mm-hmm.
And we've been keeping that track. Well, it was, I think, December 23 when we put together that list. And there's been some very nice winners. Woo! And it's on the basis that equity guys can buy the senior golds.
Yeah.
And you're going to get average. Midland golds will be a little better. And then the tag in, of course, to the juniors. And if you have a portfolio, say 10 or 11, as we're recommending, you can get some terrific moves in these things.
Sure.
They the way the bottom of a bear market, and that was a long time ago for gold.
Yeah.
Is first of all, the seniors bottom and they move up. Then the middle ones bottom and move up. And then finally, the play gets enough confidence to go for the juniors. So this is where we think it's a good way of getting exposure in gold equities is the juniors. And anybody can get in touch with us and we'll give you the list.
All right. So just send me an email, kl@kerrylutz.com. I'll make sure that Bob gets you the list. That list has really been paying off handsomely lately. I like the juniors, and I won't name names, but ones that have uplisted to like the New York American or the NASDAQ. There aren't that many of them, but those stocks now, the funds can put money in, and it's a whole new echelon of investor. Have you got a list of them?
Yeah, we have.
All right.
I think there's 11 in the list. We update it every 2 or 3 months because some of them have moved and a couple were turkeys.
Yeah, well, you're going to have that. I mean,
well, that's why we took 10 or 11. I think the list was 11. We thought it was a lucky number.
Are we done yet, or are we going to see how much longer does this bull have to run? I mean, every good thing ends eventually.
It's going.
Yeah.
I keep saying we're only a few years into a multi-year bull market for gold stocks.
Mm-hmm. Yeah.
And of course, they will be influenced if we get a major hit in the stock market. Who knows, maybe next year. The gold stocks will sell off with a major hit to the New York Stock Exchange.
All right.
So, yeah.
I love it.
Oh, and then there was a really good headline the other day about foreign investors rolling into New York to buy the New York Stock Exchange. And, of course, that was the game in the summer of 1929. Mm-hmm. International money was coming into the New York Stock Exchange because they were big stocks, acting very well, liquidity and all that sort of stuff. And there's a little vignette about Radio Corp of America, if we've got time for it, Kerry.
Yeah. Tell us, please, Bob.
Okay. RCA, Radio Corp of America, was the big high-tech darling in the 1929 market. And I think it went up to $125. Anyways, but the street was estimating $3 a share earnings, and this was wonderful. And of course, it didn't. It crashed down to about $1.50, and earnings went down to zero.
Yeah.
But they eventually got back up to $3 a share, and that was in 1956 with the Elvis Presley contract.
Really?
And in 1929, who could predict Elvis Presley? You can't, it's impossible. So the story changes. So here's another one. The 1873 bubble the big high-tech stock was the Western Union telegraph.
Mm-hmm.
So that was the high-tech stuff, and even more exciting for Western Union is they were providing the ticker tape into all offices and brokerage offices and all that sort of stuff. So Western Union got way up there. Now, I can't remember the price, but I do remember the headline in September, October of 1873, after that bubble was over.
Wow.
And in a week's time, it gave up 40%. And this was the big high-tech darling.
Mm-hmm.
So, I mean, giving up 40% in a week for a stock like that is devastating. So.
Yeah, this is true. All right, Bob. Well, hey, everybody, just if you want Bob's latest 11 stocks, and they've been performing quite well, shoot me an email, kl@kerrylutz.com. You can find Bob. Just do a Google search. He's all over the web. And, hey, of course, ours is financialsurvivalnetwork.com. We're now using Substack, have done away with our website altogether. It's working amazing. It handles mailing lists. It handles audio. It handles the video, and also is a great writing platform, which we've been writing a lot of things lately. And we'll write one about this. Appreciate you coming on as always, Bob. We will talk to you again soon.
Good deal. We had some fun, Kerry. Yep.
Always. Be well, my friend.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.